bought it. So this trade went. If you look at the tweets from last night, the gold was 54 points and positive. Don't think that's true. Well, of course, you can obviously check it for yourself, but here we go. If you don't have the tweets, here it is here. You'll see that in last night's tweets, we had gold as 54 points and positive. It is a record-breaking implied volatility. Record-breaking implied volatility with a bullish skew last night. Bullish skew. So obviously I'm going to be very, very, very interested when the value starts coming in on the buy side, and we're going to be squeezing day session highs, because obviously this is the weak seller up here, isn't it? So we're going to squeeze that guy. So we bought some 41.26s. We know that we've got 54 points of implied volatility. So there's the 54 point target just up here, 41.80. And by goodness, as if by some sort of voodoo magic, come 5 o'clock in the morning, target was hit. Imagine that, guys. Target being hit based on the dealer's pricing of the marketplace. You couldn't make it up, could you? $5,400 banked whilst you sleep in the overnight session. $5,400 per contract. Banked whilst you are fast asleep in the land of Nod, dreaming of waking up to a $5,400 per contract profit. Now, what happened next was more spectacular. You couldn't get much more spectacular than that. But my God, gold provided. So what happened? Well, once we've now reached that target, of course, one of the things that started to happen as we came into the London session was, you can probably see it for yourself, the value started to come off at 41.90. Why are we interested in 41.90, you might ask? Well, because you know that the massive call wall is 42 with another call wall at 41.90, surprisingly enough. So we have these massive call walls. We've already gone more than one standard deviation from the overnight session. The skew's gone neutral. So I'm going to be looking now at this and saying, okay, well, this is massively overpriced. It's got to be 41.90. Well, was I in for a surprise, Nick? Damn tootin' right I was in for a surprise. Look at this. Look at what happened next. I couldn't believe my very own eyes. I was like, holy schmoly. It just went 41.90 to almost 41 handle. 41.90 to almost 41 handle. Almost. And you're looking at it saying, what? So a $5,000 overnight long, and then you've just put in a $9,000, $8,000, whatever you made out of it, short. $14,000. Sweep to the downside. Now, obviously, on the sweep to the downside, I've got a nice exit price into the bottom edge. Why is this price of interest for me? Why have I got this price even marked off in the first place? Well, because A, there was no suggestion that I wanted to go bid at any stage here. But what was more important? Well, what was more important was the fact that this was also the US session lows, which we always mark off anyway. So there's the US session low just there. There was the big pivot price we had just there at 41.10s. And obviously this is going to be a very, very interesting target price for any short sales, and just a massive amount of surprise that we got there in the first place. We've been talking about that since. I did take another short sale into this pullback. I was very, very excited about selling back into this. We hit target number 1, which I talked about in the room this morning. I suggested about another trade coming in, and obviously the idea was I scalped that, and that was live when I was in the room this morning. We managed to get scalp target number 1 for just over $1,000. I also talked about this being a rejected trade that we could get short into with a target price of 41.43s, and you can see that it did exactly what we thought, except the value was a little bit bullish, and that stopped me from taking this as a short sell. Damn it, eh? So the macro looks great, but the macro is also bullish at the bottom edges. So for me, it looks like we're going to get a compression of the market. The spreads are going to start narrowing, which is kind of what's happening right now. The spreads are narrowing right now, which obviously means that it's dangerous to play at the moment, isn't it? It's dangerous to play unless you've got a good, clean read about what they're going to be trying to accumulate in the next phase of the market. And I don't have a clean read about what they're going to accumulate in the next phase of the market. So not for me on this occasion. I'm leaving it alone, and I'll move on to someone else. The big trade we've been talking about is, of course, in the bond market, but we'll come back to that in Classroom. I can't be bothered looking at it just now, so we'll come back to that in Classroom later. Let's get through today's numbers, because we do also have quite a few numbers to work through. There were some big numbers out of the UK this morning. We also had the Eurozone CPI prints, but these are generally very, very boring. They generally are very much in line with forecasts. They generally are always revised, so we don't really get much of a wiggle room on these types of trades. But in the overnight session, it started with a disappointing retail sales at 2% against the forecast of 2.9% for the UK. This is always at midnight on the retail sales day. So moving past that, we can come into the CPI prints here in Eurozone, and as I said, they're nearly always in line with expectations. You don't normally see anything surprising here. The big one for us was, of course, the UK's unemployment number. This is the UK's equivalent of non-farm payrolls, and quite a disappointing print, wasn't it? Employment change forecast at 123 came in at 91. Earnings came in a lot higher again. Pesky bloody earnings. Can't get this earnings number down at all. That's inflationary. Unemployment rate did uptick from 4.7 to 4.8. So another set of bad numbers for the Labour government to try and comprehend and try and explain that it was all the previous government's fault, of course. Moving past these numbers, we can move into the ZEW current conditions, the economic numbers, and another disappointing number for the Eurozone, coming in at minus 80 against the forecast of 74.8. So it was worse than forecast, and it was also worse than prior of minus 76. 39.3. Economic sentiment, a lot worse than forecast, but better a little bit than prior. So not as bad as it looks in its bold red colouring scheme. Moving past that, we've got very little again out of the US. We need to get this US situation sorted as sooner rather than later. Obviously, the Chinese taking full advantage of the US lockdown, and still lots of noise about tariffs and counter tariffs and rare earths and all these kind of stuff going off in the background. So anyway, 6-month bill auction at 16:30, and because it's a bill auction, it's not at 1800 hours, it's at 1900 hours, as it always is. Lots of speakers today. Whether they'll throw any light on anything, we've got Bailey and Powell, of course, later on. This is obviously the most important. So Bailey and Powell speaking. If you're going to be watching, just make sure you've penciled that number out on your diary so that you're not sitting on a trade and suddenly something happens. Could they make mention of the shutdown as far as Powell's concerned? Could they make mention of tariffs and its effect on the economy? And it's going to be potentially more cuts, more interest rate cuts than before, and that's one of the reasons perhaps why we've had a bull steepener that we've been talking about in the last couple of days. Then of course that might be something that Powell makes mention of, is that bull steepener. Certainly the government aren't going to be, or sorry, the Fed itself, or Treasury isn't going to be terribly upset by the bond price going significantly higher. Of course, that's bringing yields down, the cost of refinancing a gazillion dollars worth of debt obviously makes sense if you can get it as low a yield as possible going forward. So that I don't think the big boys are terribly upset by the price going up to 123s at the back end of the curve here. Anyway, we're still short. We did sell it, and I'm happy with the sell. I think that's the right trade to be on. It is a macro bull steepener, flattener at the moment. It is a macro bull flattener, so selling into a macro bull flattener to me seems to make a wee bit of sense at this point, and and that's in line with a bull steepener on a daily chart. So that's something again we can cover later on this afternoon in Classroom. So nothing of any real consequence this afternoon, nothing that's going to catch your attention, nothing that's going to change the underlying narrative. It's going to be all about the geopolitical sound bites. It's going to be on tariffs. It's going to be on China. It's going to be on Trump again today. And of course, a lot is on the ceasefire holding in Gaza. I can see that as soon as the ceasefire was announced, that Hamas moved straight back in and started to kill loads of Palestinians, and started to re-exert their authority over the region again. So obviously that job's not quite done yet, isn't it? So I think they have to have a good long think about whether this is the right strategy at this point, or whether they should go in and finish the bloody job. Anyhow, we've had a retest back at the top edge of the NASDAQ. I've been watching that for a short-term opportunity. I've been tracking it myself, but I've not quite seen it just yet. But I've certainly been tracking it back into that top edge to see if it shows as a possible play. But a few ICE orders showing up, which might have caught your attention. That ICE order at 66.39 was quite a thing, and obviously reverse back against the buying at 66.38 could have got you short, trading 33s at the moment. I decided to leave it because I'm just going to be going to lunch, so I decided to leave it for the time being, but that certainly could have given you an excuse when you saw those buyers getting trapped at lower prices to get that short sell into play. I did mention in a little tweet, and it's something that if you still are not doing it, it's something you need to be doing, guys. And I posted it just a short while ago, and it's this little tweet here, and it's this: answer 2 questions and you can eliminate almost most of your losses. 2 simple questions. 1, can you identify target weakness? 2, are you trading towards target weakness? If you answer yes to both those questions, you should be trading using your order flow. And if you're answering yes to one and no to the other, you shouldn't. You should be waiting. So by answering these 2 questions, you can almost always eliminate most of retail losses. This is it. You don't need a 2 to 3 hour YouTube video full of waffle. You don't need them talking about how amazing they are. You don't know about indicators or anything else. All you need to do is identify these 2 questions and try and answer yes to both of them, and then put a trade on against a lean. If you can do that, you can start finding your way into some great trade opportunities. It's not a difficult set of questions to answer. It doesn't take up a lot of time. It takes a wee bit of work just to try and identify weakness, or as some people might call it, liquidity. And then to recognize that if you find a buyer and you're trying to be a seller, when the price starts trading against that buyer, you can start taking a trade. When you find a seller, when you're trying to be a seller, you can take that trade. When you find a buyer followed by a seller, when you're trying to be a seller, you absolutely can take that trade. And you want to be heavy with that trade. You want to be all in with that trade. Now, obviously, finding weakness can also come from the form of value, for example. So when I'm looking at, for example, book strength, book weakness, real book strength, real book weakness, like the paper buyers and sellers, then of course it still could mean that I'm selling from a weak position at the top edge, but given the right sequence of events, I can absolutely take my shot at it. Absolutely take my shot. And we got almost the perfect S&P sequence at a top edge. Now, obviously, this is a top edge, and therefore it doesn't qualify as a price action weakness. But you can see here, look at this trade sequence right there. Is that not incredible? You've got a buyer getting trapped off the top edge here. The seller comes in here. You get the very toxic sell candle, and then the price collapses for a huge profit. So if you can recognize that one trade there, you could have made all that money literally in seconds. Literally in seconds. Now, I mean seconds because literally the trade took place at 1300 hours, and by the time it was at 1302, you were already making a very substantial amount of money. Very substantial amount of money. All of these buyers getting trapped with ICE orders. All of these buyers getting trapped with ICE orders. And the price continued all the way through to liquidity weakness at the bottom edge. That is a great trade. That was backed up by book strength. Book strength as in sell side book strength. And obviously the drop from that sell side book strength was exactly what you were looking for. So this is not maybe as simple as it looks, but it can be as simple as it looks. Because initially, you're starting from a price action point of view, and only a price action point of view. Am I targeting weak side liquidity? If yes, am I trading towards weak side liquidity? Because I might be targeting it, but I might be trading away from it on a pullback. Well, I've got to wait until it turns back up again. It's called the interns exercise, surprisingly enough. And if you can answer yes to both, you don't have to spend 2 to 3 hours watching YouTube videos. You simply just trade instead. Find the trade, find the lean, take the trade, and make the monies. Quite simple, really. Anyway, I'm going to grab lunch. I will catch you guys when